Welcome to the deep dive. Today, we're peeling back the layers on a fintech phenomenon that really started with the simplest possible idea, sending money to a friend.
Right.
And somehow it evolved into this massive multi-billion-dollar financial ecosystem. We are, of course, doing a deep dive into the academic case study of Cash App.
That's right. And we're not just, summarizing its history. We're tackling this as a full academic analysis.
Okay.
The sources we've got, they meticulously track its origin, they dissect its unique platform economics, and chart its competitive strategy.
So the mission here is really to extract what made it work.
Exactly. We want to find the core insights that allowed this, super lightweight service to grow into a serious challenge for the big legacy institutions.
Okay, let's unpack this then by going back to the very start. When Block, which was still Square back then, launched Cash App in 2013, the main idea was low friction, fast peer-to-peer transfers. But the sources suggest the problem they were solving was actually, a bit deeper than just splitting a dinner bill, right?
Oh, it was absolutely fundamental to U.S. finance. The problem was friction and access.
Friction and access.
Yeah. For so many households, especially those, outside the typical high net worth brackets, just moving money between banks was slow.
It could take days.
Days. And it involved high fees for wires, or it was just inconveniently restricted by bank operating hours. The whole legacy system was just cumbersome.
And not very equitable in its speed.
Not at all. So Cash App didn't just offer P2P payments. It offered instant, low-barrier payments. And that directly challenged the slow, costly infrastructure that the average American had to deal with.
So they were really addressing this glaring systemic gap.
Yeah.
But if we look at the core structure, their architecture, this is where the case study says they did something, well, radically different. We've called it the reverse sequence model.
Yeah.
What does that actually mean in practical terms?
Okay, so this is where platform economics gives us the crucial insight. Traditional banks, they operate on what you'd call the account model. They require heavy identity verification, full regulatory compliance, setting up an account first.
All the paperwork.
All of it. And then they offer services outward from that account. Cash App did the complete inverse.
The opposite.
The total opposite.
Yeah.
They started with the network model, just simple P2P payments, which needed minimal verification, and it just worked like a utility.
Get people on board first.
Get them on board, build a massive network effect, build user trust. Then they began expanding inward by introducing the full financial products, the cash card, direct deposits, investing.
That's fascinating. So the starting point wasn't a bank account at all. It was a simple utility. Why was that so powerful psychologically for those early users?
It just annihilated the psychological barrier to entry. Think about opening a traditional bank account.
It's a whole process.
It's paperwork, it's maybe minimum balances, waiting periods. Opening Cash App was instant. By requiring so little commitment up front, they got millions of users who, frankly, never would have signed up for a full checking account online. The sources really emphasize this, that speed of adoption was only possible because they pushed off all the complexity.
They deferred the regulatory stuff until later.
Until the user was already deep inside the network.
And that tech approach is tied directly to their design, their user experience. The sources talk about a specific mobile-first architecture. How did they make it feel so effortless?
Well, it was a deliberate rejection of how financial apps looked and felt at the time.
Okay.
They prioritized these lightweight screens, remove all the extra data. One design detail the case study highlights is that you immediately get the $sign button.
The main action is right there.
It's the primary singular action. And then you get these instant transaction confirmations and the use of easy-to-scan QR codes. It all created this sense of speed and, intuitiveness. It was built for the speed of the mobile internet.
Not the speed of old mainframe banking.
So,
But, speed always brings up the question of security. If the entry barrier is so low, how did the platform maintain trust and manage fraud without just slowing the whole experience down?
that whole trade-off was managed by leveraging data. Purely data. The case study notes they use sophisticated, data-driven risk scoring.
So it's happening in the background.
Completely in the background. Instead of making security a roadblock like, mandatory two-factor on every single login, they integrated transaction monitoring and behavioral analysis. They use machine learning for identity verification and fraud management, and they score risk per transaction, not per user sign-up.
I see. That makes sense.
Yeah, so it allows the trusted high-volume user to have that frictionless speed while, a high-risk or unusual transaction gets instantly flagged.
That perfectly sets the stage for how they scaled. Let's look at their strategic rise. This wasn't just organic growth, it was a series of really crucial, deliberate product moves. How do the sources chart that trajectory?
So we can map their rise across three critical phases. The first, as we mentioned, was the launch phase, from about 2013 to 2016.
Right.
That was focused entirely on establishing the P2P network. They just needed the maximum number of users.
Just building that foundation of liquidity and trust.
Exactly. And then came the radical shift, the transformation phase, from 2017 to 2019. This is the period that really defined them as a challenger.
This is when they added all the other stuff.
Yeah, they introduced three key products almost at the same time. The cash card, direct deposit, and maybe most notably, the ability to buy and sell Bitcoin.
I want to pause on Bitcoin for a second. Why did they integrate crypto so early? I mean, this was way before almost any other major P2P platform in the US. What was the goal there?
The sources suggest two things. First, it was a huge differentiator against rivals like Venmo.
Sure.
But second, and probably more important, it was a way to acquire and engage a really specific, highly valuable demographic. Younger, risk-tolerant, digitally native users.
The people often overlooked by traditional brokers.
Exactly. By offering Bitcoin, Cash App kind of solidified its reputation as the platform where future finance was happening, not just current transactions. And that deepened user engagement like crazy.
And the cash card was really the pivot point, right? It turned them from just a service into a fully monetizable asset.
Precisely. The cash card gave them a physical presence, and it let them capture interchange fees, which totally changed their revenue model. We'll get to that in a bit. But then we get to the third phase,
The ecosystem acceleration phase.
starting in 2020. And this is where the sources identified a crucial kind of unplanned inflection point.
You're talking about the COVID-19 stimulus period. This is where it gets really interesting. How did a global crisis become the strategic windfall for Cash App?
Well, the sources argue that Cash App basically benefited from a state of emergency.
Okay.
When the U.S. government needed to get stimulus payments out fast, Cash App was already there as a quick, verified channel for tons of users.
Especially users who maybe didn't have a traditional checking account they could easily access.
Or who were still relying on physical checks. Because some users got those vital government funds deposited directly into their Cash App account, it gave the platform this unparalleled level of consumer trust and, frankly, regulatory validation overnight.
It effectively put Cash App on the same operational level as a traditional bank for millions of people getting aid.
That visibility and trust, priceless. And this momentum led to their ultimate goal, creating this circular financial system.
Closing the loop.
Exactly. By integrating Cash App users with Block's merchant tools, they closed the loop. A user could now get paid their salary via direct deposit into Cash App, maybe invest a little in Bitcoin, and then use the cash card to spend that money at a Square merchant coffee shop.
And Block captures 100% of that entire transaction cycle.
The whole thing.
So if the initial land was simple P2P, the strategy became expand vertically and close the spending circle. Okay, now we have to talk about how this created the robust revenue machine we see today.
This is the absolute textbook success story of land and expand in FinTech. The P2P network was, at first, a loss leader.
Just a cheap way to get customers.
It was a super cheap way to get the customer. And once they had them, they just layered on services to drastically increase the lifetime value of each user.
The original monetization was minimal, wasn't it? Just a small fee for instant transfers if you didn't want to wait for the standard bank transfer.
Exactly. It was a friction fee. But today, the sources detail this really comprehensive multi-layered structure. It's designed to capture revenue at every single touch point. We can break it down into, say, 4 critical layers.
Okay.
First, and maybe the most reliable, are the interchange fees from the Cash App card.
Right. And just to clarify for everyone, that's a fee the merchant pays, not the user.
Exactly. When you use your debit card, Cash App takes a small percentage paid by the merchant or the payment processor. This means the primary utility, the P2P transfers, can stay free because it's funded by the card usage fee captured downstream.
It's the classic FinTech magic trick. The user gets the free service, the business pays the bill. Okay, what's the second major stream? The one often tied to their high-risk, high-reward image.
That would be the Bitcoin trading spreads. Cash App doesn't charge a visible commission for basic Bitcoin buys.
No, they don't.
Instead, they operate on a spread, which is just the difference between the price they buy Bitcoin for and the price they immediately sell it to you for.
And with the massive volume of retail crypto trading, That adds up.
Oh, it provides a highly reliable, high-margin revenue stream.
And the third layer is all about capturing the user's primary financial relationship.
That's direct deposit. Revenue from users who get their salary through direct deposit is absolutely critical.
Why? Because they're stickier.
They are highly engaged and represent a stable, high-value group. They are much less likely to churn, and they're more likely to use all the other services, like Cash App investing commissions and business payments.
Securing that paycheck is the ultimate form of customer lock-in.
It really is.
Okay, let's turn to the competitive battleground. The U.S. digital payment space it's brutal.
Yeah.
When we analyze the sources, who are Cash App's most formidable rivals?
I mean, the list is long and intense. You've got the direct P2P competitor, Venmo, which is owned by PayPal.
Right.
You've got Zelle, which benefits from being built right into hundreds of traditional bank apps.
The hardware giants?
The hardware integrated giants,
Yeah.
Apple Pay and Google Pay. And then finally, the challenger banks like Chime and SoFi, which compete directly for that primary account relationship.
That is an incredibly crowded field. So how do the sources explain Cash App's ability to not just survive, but actually thrive among all these heavyweights?
Their key differentiation is deliberate accessibility. They didn't go after the high net worth customer. Cash App specifically carved out a niche by serving the financially underserved younger people, lower income groups, and individuals who are, unbanked or underbanked.
For those groups, it's not just a convenience.
It's a necessary, accessible financial tool. And that targeted focus gave them a huge advantage in market segments where traditional banks had just historically failed.
If we look at this through the lens of, say, Porter's forces, the sources confirm this is a really tough environment for everybody.
Absolutely. The competitive forces are strong. Buyer power is high because switching wallets is almost effortless.
If Venmo has a better perk, you switch.
You switch. The threat of substitutes is significant. You can always use a bank transfer, a credit card, cash, and rivalry is intense. However, the sources note that Cash App built a defense mechanism.
The internal network effects.
Those internal network effects, if you're using Cash App for P2P, getting your salary, and trading Bitcoin, the hassle of trying to replicate all of that across 3 different competitors, it drastically reduces your chances of churning.
They layered complexity strategically to keep people from leaving.
That's a great way to put it.
I see the logic, but for a platform that grew so fast and targets a pretty challenging demographic, the risks must be substantial. What are the big structural challenges the case study highlights?
4 really stand out. First, fraud risk is paramount. P2P platforms are, they're hotbeds for social engineering scams.
Yeah.
Users are often tricked into sending money, and the platform, because it's so fast, faces constant liability. It's an ongoing, expensive battle.
And that leads right into the second major risk, which is catching the eye of governments.
Precisely. Regulatory scrutiny. The oversight is escalating fast, especially around consumer protection, KYC know your customer rules, and particularly how they handle crypto trading.
Regulators are still trying to figure out what it is.
Yeah, are they a payment processor, a bank, a trading platform? That uncertainty is an ongoing threat.
Then there's the big one, the strategic threat that hangs over any mobile finance company that doesn't control the hardware.
The major strategic threat from Apple Pay. Apple has this deep, seamless hardware integration on the iPhone, which, dominates the U.S. mobile market.
It's a structural advantage.
A huge structural advantage. The Cash App, as just a software provider, can only mitigate. They can't eliminate it.
And finally, market exposure.
Yes. Market concentration risk. Cash App is so heavily reliant on the U.S. market. This concentrates their exposure to our domestic economy, to interest rate shifts, to U.S. regulatory changes. They just don't have the global diversification that a PayPal has.
So let's bring this all together. If we synthesize the origins, the strategy, the economics, what is Cash App's final legacy and impact on the financial landscape?
Well, I'd say its impact on financial inclusion is profound. For millions of younger and underbanked users, Cash App isn't a supplemental tool, it is their primary financial operating system.
A lightweight, functional alternative to a bank account?
Exactly. By marrying that simplicity with strategic high-value product integration, it has fundamentally redefined what people expect in terms of speed and accessibility in mobile finance. It's really the ultimate success story of FinTech evolution.
It really is.
They leveraged network effects to get customers cheaply and then just layered high-margin services right on top, all while navigating this fierce competition.
Yeah.
By focusing on demographics that everyone else ignored.
Ultimately, the sources show that Cash App succeeded because it was just willing to be radical. It reversed the traditional model, it integrated Bitcoin early, and it focused on the speed of the smartphone, not the speed of the clearinghouse.
Hmm.
So we'll leave you with this final provocative thought. Cash App has successfully established itself as the default financial institution for millions of users who were previously underserved. So since these new digital ecosystems operate at the speed of mobile data, how must regulators adapt consumer protection rules written for traditional, slow banking models, to address the speed, the complexity, and the inherent volatility found in these new digital-first financial platforms?
It's a huge challenge. It requires rethinking the foundational principles of financial protection for the 21st century.
Absolutely. Thank you for joining us for this deep dive. We'll catch you next time.